Wow, it's about halfway through today's live show, and it's time for today's special feature. The special feature is not a question that anyone has been asking me. It's something that's been on my mind, and something that typically I choose something that's been coming up for me several times during the course of the week. And one of the things that's been coming up for me a lot in my mind recently has been this concept of story. And if you circulate at all in accounting circles, you often hear financials tell a story. Financial statements tell a story. I heard that during one of my very first accounting classes. And because I was brand new to accounting, let me tell you, I had no idea what story financial statements were telling. I believed my professor, I just had no clue. And it wasn't until I was working in a CPA firm for a good 2-3 tax seasons before I was looking at the financials of a company. And by this point, I had done their taxes for several years. And so as I opened it up, I remembered their situation from the prior year or two. And all of a sudden, boom, got my light bulb moment. Oh my gosh, these financial statements are telling me a story. Okay, I don't want it to take 2 to 3 years plus an MBA in professional accounting for you to get what I got, because that was way too expensive and it took way too long. What does it actually mean when financial statements tell a story? I'm going to give you a couple of examples. For example, if you look at a balance sheet, and don't just look at a balance sheet, look at a comparative balance sheet. How are we now versus this time last year versus this time the year before? A trend will tell a much more powerful story than one period only. So that's the first big lesson. Hey, Deborah! Deborah knows exactly what I'm talking about, how comparative financial statements tell a much more powerful story than financial statements for a single period. Don't you know what I mean? I know you do. It'll take like 13 seconds before you hear this and then you'll reply, but I know you know exactly what I'm talking about. So for example, what's on the balance sheet? Assets, liabilities, and equity. Let's consider liabilities. If in year one, there's a huge liability, way more than there is, let's say, money in the bank, that can tell a story, a possible story of an organization that's struggling. However, hey Bonnie, welcome! In a 3-year comparative balance sheet, let's say you see that liability decreasing and cash remaining steady. That's a big deal. If the money in the business account remains steady, but debt is decreasing, that means that the organization is managing to hold steady while paying down debt. That's a big deal. If you've ever paid down debt or led an organization paying down debt, you know exactly how much of a big deal that is. Hey, Jonathan, welcome. Yeah, you know exactly how much of a big deal that is. And if you want to know more of the story, you can look at the income statement, also known as the profit and loss. But we'll get there. Let's consider something else, opposite effect. Let's say liabilities are increasing. That means the organization is taking on more and more debt. Is this a good thing? Is this a bad thing? In and of itself, it doesn't mean anything. Debt isn't good. Debt isn't bad. Debt is debt. What does it mean in context? What's the story? Well, what if we also see on the balance sheet that we have an equally large jump in fixed assets? Example, the organization just bought a brand new building and filled it with equipment. Wow, I hear you saying to yourself. They bought a building, filled it with equipment, they got it financed with debt, so they're not emptying out their bank account, emptying out their rainy day reserves. Good for them. They're obviously planning something huge. Their story is they're about to make a huge investment in a bigger future and make more of a difference in people's lives. That's amazing. But that's part of their story. Hey, Sam, welcome. It's so great to see you here. Those are two examples. Let's go with another balance sheet example. How about accounts receivable? Let's consider a 3-year trend. Let's say accounts receivable, in other words, the organization has provided services and not yet been paid for them. That's accounts receivable. If that's, let's say, increasing over 3 years, what does that mean? Is it good? Is it bad? It doesn't mean anything until you get more information. What if it's increasing a little bit, but income over on the income statement is really taking off? Well, that's amazing. I mean, if cash is holding steady, hey, I apologize. And I hope that everyone who is on the first part of my live show can come on back and find me here. We had a glitch with the Facebook video, but I'm back and I'd love to have you here, welcome you back, and share with you more of this story. If income is really taking off and receivables are climbing by just a little bit, that's amazing. You're gonna have healthy cash. Oh, great, Lisa, Sam, I'm so glad you found me again. Yeah, we had a little Facebook video glitch there. Then that's amazing news. And it means that more and more business is happening, but but by and large, people are paying for the services. If sales are accelerating at a faster rate than receivables, that's a story. And that means that you're gonna have a lot of extra money or a lot of additional money, which you can either reinvest in the business, you have the business pay you, or increase your rainy day reserve, or decrease interest expense by paying down a loan on that big building with all of its equipment, etc. So those are some examples of how financial statements, parts of financial statements can tell a really powerful story. Here's another aspect of it. We'll stick with the income statement. Margins, especially over time. So we have gross margin, for example. Typically, gross margins, once an organization is established, gross margins would remain steady over the years. If that's happening in your organization, then congratulations, you've reached a level of stability. That could be part of your organization's story. Let's take a look at net margins, for example. And if you're in a for-profit business, let's consider net margins exclusive of owner compensation. If your organization is growing, but net margins are remaining flat, it could mean that you're telling the story of reinvesting in the organization to help it grow. But if the organization's income is not increasing and margins are decreasing, then it's possible that the story that it's telling is whatever you're reinvesting in the business to help it grow isn't working. And it may be time for something new. So these are some quick thoughts, some quick examples about how financial statements can tell a story. Comparative financials, even more powerful than just a single time period. You can divide it up by years, by months, by quarters. You can look at it by months, particularly if your business is cyclical. If you have an uptick in business during a particular time of year. Lisa, your business selling karate uniforms would be a good example of that, because there's an uptick in business when the school year starts. School year starts and a lot of parents enroll their kids in martial arts classes, and naturally you're going to see an uptick in uniform sales at the same time. Barbecue, I did a financial model once for a company selling barbecue sauce. Huge uptick in the summer, but a secondary uptick in Super Bowl season. And so telling a story, look at the financial statements on a monthly basis. Hey, Danielle! And not just an annual basis is a very powerful one. And so consider that.